of them as storm clouds. We don't know if they're going to hit, when they're going to hit, what they're going to do. Okay, so I'm not predicting that, but I'll tell you what I worry about. So one is the fiscal money being spent is so big, largest in peacetime ever, America and kind of around the world, with already very high deficits. And QT we've never had. So I know some people think QT will be uneventful. I'm not so sure. At a minimum, I expect volatile markets, and then you've got, and then all the long-term fiscal things are kind of inflationary. You know, oil prices, certain commodity prices, the green economy, you know, the restructuring of trade, you name it, I see it's adding to inflation, not subtracting inflation. So I don't think inflationary will be that, you know, keep on coming down. It may not. And therefore, rates may go higher. But the biggest storm cloud is geopolitical. It's going to affect all global relationships in America and China, trade alliances. We don't know how it's going to start either. So I just put those two things as I keep a close eye on. And then how it affects the economy is different. And when I've been talking about that is, I just tell people, be prepared for higher rates and slower growth.
7%. Are we really going there? And
how
does
I don't know. When I said 5%,
growth?
They said, are we going there? Yeah, it's possible. You know, so when I talk to my board, I say, yeah, can it go to 7%? The answer is yes. Are there factors that would drive it, you know, higher than, you know, where it is today? You know, 4.5, 4.6, or 4.7, I'm talking about a 10-year bond now. Yes. Is supply and demand could push high? Yes. I'm just saying, be prepared for it.
So
and then the worst case is stagflation. You know, higher rates because you have a booming economy and there's a lot of competition for capital is not the same thing as stagflation.
What are the ripple effects of the stress of that 7% rates on business, on your growth?
Well, I'm not worried about JP Morgan. JP Morgan, you know, we are prepared. We can handle 7%. We can handle 2% again.
8%?
Yeah, we can handle that too. I mean, that risk management is not the same thing as guessing the future. When risk management, looking at the range of potential outcomes and being able to say to yourself, we can handle this, we can handle this, we don't really expect it, and we can handle the in-between. You know, if you bet your company on, you know, one outcome, so I think all companies do that. You know, and every company's got different exposures, you know, input prices, output prices. You know, some interest rates don't matter, some it's the price of mozzarella. So, you know, what's your business? Your business is different. So, but I think we don't know the effect of these things on the economy. So we may have a soft landing, we may have a mild recession, we may have a harder recession. You know, obviously there are potential bad outcomes. The worst one would be economically is stagflation,
right?
Where you have low growth, high interest rates, and obviously if that happens, you're going to see, you know, a lot of people struggling.
Where's China on the list of risks?
When I say geopolitical, that's the big one. It's the thread from Ukraine, oil and gas, food, migration, all our relationships. The most important one being China. That is the most important for the future of the world, and obviously Ukraine is affecting it. And in fact, it's very hard to see really positive outcomes with China until the Ukraine war is resolved. Hopefully, where the Ukrainians could say they have a victory of some sort.
Welcome to Key Stock and Crypto channel. Don't forget to like and subscribe to the channel. Support this great content by hitting the cash app and by joining the Patreon.
And we have Jamie Dimon talking about the geopolitical events. And we know these big banks have survived the pumps and dumps because the banks are the biggest what? I'll let you finish that. But we know the consumers are being eaten up from inflation and higher rates. And these rates are going to be higher for longer. And we have the funny news. Remember, guys, this is all a movie. Sam Bankman-Fried considered paying Trump $5 billion not to run for president. Guys, where was he going to get this $5 billion from? I forget. He had his own printing press. Now, I'm going to try to bring you at least 4 videos per week on the stock channel because now things are about to tighten up. All you have to do is look at the indicators. The yield rates are rising to numbers we haven't seen in about 20 years. We have the dollar rising, and we know those two things are going to bring down the market. We had the AI pump. Right now, guys, you're looking at energy. You know, always talk about Exxon, Chevron. We know the Rockefellers are not going anywhere. Right now, the consumer is hurting due to inflation and higher interest rates, like I stated. So we also know Walmart is going to benefit from it all. And then plus Walmart is set up for the 4th Industrial Revolution. We can clearly see they're slowly getting rid of their cashiers and bringing in all automation. And we know Amazon is doing the same. Even though we see this lawsuit, guys, we know it's 2 steps forward, 1 step back. Amazon is not going anywhere. And they are definitely set up for the digital transformation. But of course, guys, I'm going to be going over stocks on a daily basis. Like I stated, I'm going to try to bring you at least 4 videos or more per week on the stock channel going forward. Now, guys, make sure you're paying attention to the actual indicators. We had yield rates rise, we had the dollar rise, and of course, that had the VIX moving. The VIX hasn't moved much, but I guarantee in this fourth quarter, it's going to be very volatile. Now, we had crypto get a boost from Ethereum futures launch. Remember, guys, crypto is the future. Stocks are going to be tokenized and put on blockchain. And we had Kramer talking about the bond market because he knows what's about to happen. We've seen the Kramer movie before. He's not going to tell you, but he's definitely going to give us that signal. Now, we know the fourth industrial revolution is going to rise in the emerging markets first. And AI is going to make people more productive. Is that correct? No, it is not. AI is going to replace people. AI is going to be more productive on its own. Remember, the machine doesn't need health care. It doesn't need a break. It's not going to call out sick, and it's going to work all day. Now, we have the UAW strike, which no one is paying attention to. But guys, like I keep saying, it's going to hurt the global economy. More layoffs. It doesn't seem like a lot. But remember, you already have thousands already out of work and then plus receiving less income, and we're rolling into the holidays. And like Trump stated, these electric vehicles are going to be built in China. We know the subsidies that Elon Musk gets from China. Don't forget that. And then we had the Fed Michael Barr talking about interest rates and how they're going to take a little longer to seep into the market. And guys, we know that's the reason why the Fed raised rates so fast, because they know it takes time for the interest rates to catch up with the actual economy. Now we're seeing it. Now we're seeing all the holes in the economy. Remember, when they first started raising rates, the consumer had over $2 trillion in savings. Now it has moved all the way down to $190 billion. We have trillions of dollars in credit card debt. Auto loan delinquencies the highest since the 2008 crisis. But the mainstream media is not going to push that message. And things are clearly going to get worse. We know they cause the problem, wait for the reaction, and run in with the solution. And what's the solution, guys? Automation. And plus universal basic income, where they're going to be able to airdrop you that free money. But little do the people know that money is programmable, telling you what, where, and when and how to buy, and you have 3 to 6 months to spend it or poof, it's gone. And remember, the crypto teacher told you. Now, guys, that's all I have for you. Make sure you go to the main channel and check out the crypto teacher. So therefore, you can learn the new economy, get your friends and family educated, because you do not want to be caught on the wrong side of history. Have a wonderful day.
Recent interest rates all over the place, the long end, the short, and the middle, has created havoc among multiple funds. It's like a giant grim reaper that cuts down sector after sector. And that's how you get days like today, which at one point was so ugly, but then rebounded at the close. Dow still finished off 74 points, but the S&P edged up 0.1%, and then NASDAQ held up all day, finishing very strong. I want you to keep that in mind, +7.
A big day in ETF history, if you will. So to the first point, yes, investors, traditional investors now have access to Ethereum, which is really, I would call it a pure play blockchain play, because Bitcoin has got this sort of aspects of gold. So it's interesting, it's the first day. True, investors, what the fund holds, the ETF holds those ETH futures, Ethereum futures, not the spot. So there are, I would say, a couple of issues relating to that. One is, does the futures curve track the price of Ethereum? And then there's some tax issues that aren't as good as a spot Ethereum ETF. But I think what's historic about today, Morgan, is that for the first time, the SEC organized it so that at least 4 ETF issuers came to market on the same day, which has never happened before.
Industry you're in, I guess the starting point for thinking about it might be that it's going to make all of us more productive. and it's going to be a force multiplier. We just don't know exactly by how much and when that's going to materialize. For our portfolio companies, we're working with all of them to understand the opportunities and the threats occasioned by AI.
30 employees at Ford who will be laid off either starting on September 30th, they were laid off, or on October 7th or 2nd, which would be tomorrow. These are employees who are at the Chicago stamping plant or at the Lima, Ohio engine facility. The reason why? Parts are not needed since the Chicago final assembly plant is on strike, and that's the plant where they build the Explorer as well as the Lincoln Aviator. So when you look at those two facilities, doesn't sound like a huge amount of jobs, 330, but this is now 930 altogether that Ford has had to lay off between these two facilities as well as the Wayne final assembly plant after the strike was called there 2 weeks ago. And this is a case where Ford is saying we have to lay these employees off because the parts that they would normally make that would go into production in a particular facility, they're not needed because that facility is on strike right now. So another 330 jobs where the employees are laid off at Ford.
And it's how long the Fed remains restrictive. Full effects of tightening, he says, are yet to come. That's him weighing in an important debate among Fed officials, and he's more in the we're not done with the lags yet. He said the Fed can proceed carefully at this point. The economy, though, is showing more resilience than he expected. He sees a higher probability now that the Fed can avoid large increases to the unemployment rate, and that is without the degree of job losses you might usually see with the amount of policy tightening that they've had recently. He says they're making progress bringing labor supply and demand back into balance, and he expects GDP to moderate below potential for next year with some softening in the labor market. It's